Hi, and welcome to No Invierta en Bolsa, Especule.com. My name is Eduardo, and today's video is about futures and futures-related terms in English. A futures contract is a financial contract obligating the buyer to purchase an asset or the seller to sell an asset, such as a physical commodity or a financial instrument, at a predetermined future date and price. Futures contracts detail the quality and the quantity of the underlying asset. They are standardized to facilitate trading on a futures exchange. Some futures contracts may call for physical delivery of the asset, while others are settled in cash. The futures markets are characterized by the ability to use very high leverage relative to stock markets. In many cases, the underlying asset to a future contract may not be a traditional commodity at all. That is, for financial futures, the underlying item can be any financial instrument, including currencies, bonds, and stocks. They can also be based on intangible assets or referenced items, such as stock indexes and interest rates. Who trades futures? Futures traders are traditionally placed in one of two groups: hedgers, who have an interest in the underlying asset and are seeking to hedge out the risk of price changes, and speculators, who seek to make a profit by predicting market moves and opening a derivative contract related to the asset on paper, while they have no practical use or intent to actually take or make delivery of the underlying asset. In other words, the investor is seeking exposure to the asset in a long futures position, or the opposite effect via a short futures contract. The price of the underlying is the main factor that determines prices of derivative securities, warrants, and convertibles. Thus, a change in an underlying results in a simultaneous change in the price of the derivative asset that is linked to it. In most cases, the underlying is a security such as a stock or a commodity. Margin is the amount of money deposited by both a buyer and a seller of a futures contract and is required by both parties in order to initiate a futures position. This is usually 5 to 15% of the contract. The exchange will draw money out of one party's margin account and put it into another's so that each party has the appropriate daily loss or profit. If the margin account goes below a certain value, then a margin call is made and the account owner must replenish the margin account. This process is known as marking to market. Settlement is the act of consummating the contract and can be done in one of two ways, as specified per the type of futures contract. Physical delivery is the amount specified of the underlying asset of the contract that is delivered by the seller of the contract to the exchange, and by the exchange to the buyers of the contract. Physical delivery is common with commodities and bonds. In practice, it occurs only on a minority of contracts. A cash payment is made based on the underlying reference rate, such as the closing value of a stock market index. The parties settle by paying or receiving the loss or gain related to the contract in cash when the contract expires. Cash-settled futures are those that, as a practical matter, could not be settled by delivery of the referenced item. Or How would one deliver a stock index? Expiry is the time and the day that a particular delivery month of a futures contract stops trading, as well as the final settlement price for that contract. For many equity index and interest rate futures contracts, as well as for most equity options, this happens on the third Friday of certain trading months. For example, most CME and CBOT contracts, at the expiration of the December contract, the March futures become the nearest contract. This is an exciting time for arbitrage desks, which try to make quick profits during the short period, perhaps 30 minutes, during which the underlying cash price and the futures price sometimes struggle to converge. At this moment, the futures and the underlying assets are extremely liquid, and any disparity between an index and an underlying asset is quickly traded by arbitrageurs. At this moment, also, the increase in volume is caused by traders rolling over positions to the next contract. Quadruple witching hour is the expiration date of various stock index futures, stock index options, and single stock futures. All stock options contracts expire on the third Friday of each month and once every quarter, on the third Friday of March, June, September, and December. All four asset classes expire on the same day. Because futures contracts and options investors must close out their positions on those days, they often witness increased trading volume. When trading futures, the rollover is the period prior to when traders switch over to trading the new contract month. So, the open positions which are going to expire are closed, and a similar position is opened with expiry in the following contract month. Contracts on financial instruments were introduced in the 1970s by the Chicago Mercantile Exchange, or the CME. Today, there are more than 100 futures and futures options exchanges worldwide, and they include 1. The CME Group, formerly the CBOT and the CME, and they trade currencies, various interest rate derivatives, including U.S. bonds, agricultural products such as corn, soybeans, soy products, pork, butter, and even milk. They include indexes such as the Dow Jones Industrial Average, metals such as gold and silver, and other indexes such as the NASDAQ and the S&P. 2, we have the New York Stock Exchange, Euronext. The Euronext trades index futures, including the Euribor, the FTSE 100, the CAC 40, and the AEX index. And lastly, we have the Tokyo Stock Exchange, which trades TOPIX futures. Now you have several new terms related to futures, so go out and use them in your conversations. If you'd like to learn more financial terms in English, please visit our website and our YouTube channel.